The following presentation is brought to you as a courtesy from Forex Academy. This is part of our service, Become a Pro course. If you find it interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all our services for free. Your like is also highly appreciated. Enjoy.
So what does that mean, this import-export function in terms of trade? Well, we simply define this as trade balance. The answer to this balancing act is defined by a country's trade balance. As mentioned, those who are net importers run a trade deficit, whilst those countries who produce more output for international markets than they purchase in run a trade surplus. Okay, so notable economies that function with a trade deficit are the United States, Canada, Japan, and Mexico. And the most common countries or states that run a trade surplus are Switzerland, China, Germany, and Russia. Again, we can see with our chart here, well, what effectively does this mean? How can we put that into perspective? It's a simple value of imports or exports minus imports, or vice versa. This is effectively what we're seeing here, and we'll choose the United States as an example here. This is the United States. We can see that its exports greatly underweighs the amount it imports. Okay, so we can see the level of difference there. We have a huge level of difference, roughly around 1,400 billion euros to around just over 2,000 billion euros. So each and every year it is running a huge trade deficit, across the world, not only with the Eurozone, with across to different nations as we've seen with China. Collectively, it's running a huge deficit in terms of its level of import and export. Again, the question that we can always ask, as forex traders is, well, how does this affect the US dollar? Is this one reason why we've seen the US dollar start to really decrease over 2017? The fact that it's always running a trade deficit with huge trading partners, and there is of course strong demand for the US dollar in terms of different investments and the amount of return that those investments can create. But in relation, just understanding the fundamentals of how the country runs in relation to the supply and demand function of its currency, well, it is effectively demanding more currency from other nations, from its US dollars, than it demands locally from US dollar production or output. So effectively, we're seeing a tipping of the scales here towards other currencies, and that could cause, of course, or certainly been one of the reasons why we've seen such a negative decline in the price of the US dollar in 2016. So let's discuss then capital investment. So capital investment is so important, of course. International capital flows seek the highest inflation adjusted returns. What does that mean? Well, it means that we're trying to ignore inflation, or the eroding factor of inflation. Perhaps it's at 2%. We want returns not taking into account inflation. Okay, so if you're making a return on an equity index, perhaps, and it makes 4% return on the year annually, if inflation is 2% of the total investment, of course, well, really you've only made 2% return, given the fact of the inflation has eroded effectively the overall value of your investment. So you're looking to effectively forego inflation adjusted returns and just give a real value of your investment. So we're looking to capital flows then seek the highest inflation adjusted returns, creating additional demand for high real interest rate currencies and pushing up the rates of exchange. That's effectively what happens with capital investment. Reflecting essential consumer needs, capital investment is virtually immune to economic developments. Why is that? Well, money will flow to wherever it can get the highest return with the least risk. And that is very true. No matter if we are investors in times of a very strong business cycle, a boom perhaps, or we're moving closer into recessionary periods and we know that there may be financial trouble ahead, we're still looking to outperform and find some investment or some rate of return. Well, our money decisions are the capital flow of our decisions will change to adapt to the certain economic environments globally. So money will flow to wherever it can get the highest return with the least risk. If a nation's financial instruments such as stocks and bonds offer relatively high rates of returns at relatively low risks, foreign investors will demand its currency to invest them. So again, let's just take that into a perspective. Foreign investors will of course demand those bonds if they perhaps offer a higher or very attractive rate of return. But in demanding those government bonds from another nation, we need to buy those bonds, of course. So in doing so, we change the local currency, perhaps it's US dollars, to purchase a euro bond there, a German bond, into euros, and effectively creating a lot more demand for that local currency. Okay. So with capital investment then, international, again, we want to focus on the highest real rate of real interest rate adjusted return. Okay, foregoing this. Again, we're looking to try and pick a higher level of demand above inflation. So I want you to think how attractive a 10-year bond is at 6% interest. Okay, if we're looking to trade a bond at 6% interest compared to another that offers 2.5% interest, they're both 10-year bonds. It's your choice where you want your capital to flow into, what investment you are looking to trade with. The more attractive investment will have a higher capital flow demand, and it's going to increase the level of demand for the currency as well. Again, capital investment isn't always about the bond markets. It's not always about the forex markets. It's also about generating return across all asset classes more effectively. The stock markets provide great opportunities to do this. We did discuss the severe disadvantage that emerging markets have as opposed to those overperforming markets. So again, I'd like to ask a few hypothetical questions here. We have the Nasdaq 100 in front. You can see some of the huge stocks that we're all familiar with: Apple Inc., Microsoft Core, Amazon, Facebook. We have the two alphabets there defined as Google, Intel, Cisco Systems, huge tech companies. So with capital investment, why and how do share prices rise? So it's kind of a very straightforward question, but why and how do share prices rise? Well, because there's capital flow moving into them. It's as simple as that. Now, obviously, there's fundamentals behind why each company is deciding to invest and why they're growing and what is the story behind each company. But just from a very direct standpoint, as an investor, well, why and how do share prices rise? Well, because they are attempting to increase investment from other parties. So if I'm a pension fund, or if I'm working with a pension fund and I'm looking across the Nasdaq 100, and I know that, or I have studied the price action or fundamental analysis with Microsoft and Apple, I believe the price is going to rise in US equities over the next 3 years. I'm going to invest in these two companies over the long run. They're going to provide me with growth and value. So that might be the case. What I'm doing though practically is increasing demand for those shares. I'm buying up those shares, increasing dollar demand as well, and effectively we're seeing the share price rise and the equity index price rise as well, relative. How do European investors allocate their resources? That's another question. So not only European investors, but Asian investors, if they're looking to trade with the Nasdaq 100, it's certainly the same case. It's going to look to allocate their resources towards the US economy. Is there a direct link between equity trading and capital flow? Absolutely, there is. And that's the point we're making here. There is a very direct link between equity trading and capital flow. Equity markets demand capital to efficiently run. That is the point of capital markets, guys. When you decide to list your stock on the stock exchange, you're effectively placing it up so other investors can partake in slightly owning a part of your company. But of course, you're looking for capital investment to grow, to manufacture goods, to progress. So that's a very strong point in terms of the direct link between equity markets and capital flow. Of course, there's a direct link with the currencies as well. And does increasing trade flow increase capital investment? So again, increasing capital investment, does that increase trade flow? Absolutely. I mean, these are all, again, I started the lesson with explaining that they are inextricably linked. So again, if you're Apple at the top of the food chain in terms of the Nasdaq 100 component weighting, of course, you are looking to expand across your products and services across the world. Okay, so that level of capital investment literally is going to allow you to create new products. You're going to be able to invest in, um, you know, bringing that product across the world. You know, you can ship it across the world. Shipping, of course, can be quite costly. So you're making 100,000 iPhones for the New Zealand market. You're shipping those across the world. You're expanding. That capital investment has literally allowed you to increase your trade flow. You're trading with another nation. So they're all inextricably linked with capital investment. Let's discuss then capital flight, because it's very, very interesting, and it's something that you're going to take on board in terms of trading many different markets. Capital flight occurs when assets or money rapidly flow out of a country due to an economic event or consequence. Such events could be an increase in taxes, risk of government debt default that disturbs investors and could cause them to lower their valuation of the assets within that country, or a potential loss of economic confidence in a particular nation. Okay, so there are different factors that may cause capital flight. The affected nation can experience a dramatic drop on wealth and is usually accompanied by a large depreciation of the local exchange rate. Okay, so why is that the case? Well, again, what we've just discussed is trade flow, capital flow. You know, what is the difference? Well, they're all inextricably linked. One is more instant. Obviously, the capital flow is instantaneous. A trade flow takes time for business relationships to be made and for business to grow organically between those nations, which will in turn create capital flow. However, what does this mean when capital flight? You know, it's usually accompanied by a large depreciation of the local exchange rate. Well, of course, that is certainly the case if there's going to be a lot of capital, i.e., cash, pulled out of a certain country. There's going to be a real contraction of demand for that specific local currency. And that contraction of demand is going to see a price drop. Again, we can consult back to the forces of supply and demand there in lesson 5. Simple economics, but that is effectively what we're going to see. So the affected nation can experience capital flight and will often be accompanied by large depreciation of the local exchange rate. What we could use to explain that is, of course, the Brexit phenomenon. When, you know, I suppose one of the main fears between the the United Kingdom leaving the European Union, okay, is that it will cause a lot of ramifications in terms of trade flow across its European partners, because it does most of its business there across the Eurozone. So that is a huge factor. But what does that mean? How do we price that in? Of course, if there's a perceived huge contraction of business being done between the United Kingdom and its, you know, top trading partners, of course, in terms of imports and exports, well, of course, there's going to be a severe move in the currency. We're going to price that in, that there's not going to be the same level of organic business done across these two nations. So, of course, the currency is going to move, and that's effectively what happened. That is one of the main reasons, the main economical reasons behind sterling moving against cable, you know, 145 down to 122, and against the euro quite strongly as well indeed. So here we have yet another example here with capital flight. Okay, so we had a very large equity sell-off there in China 2 to 3 years ago, in 2015. Analysts, if you do recall, analysts referred it as Black Monday. So on 1/3 of the value of A-listed shares was lost within 1 month there, starting 12th of June 2015 in China. So a value of $1 trillion of capital flight moving from China, moving out of equity indices, moving out of Chinese yuan as well in terms of the currency depreciation. That's effectively what we're seeing here. So here we have the Chinese market here, the listed 50 index, of course. What we see is a very sharp decline in the equity price here. I'll just annotate this in the chart. You can see the highs here, straight to lows within a very short space of time. That is literally the equity market that we are observing now. And what I've done is actually just to depict the very tight, stringent relationship between capital flows and equity markets, is to show you the changing structure between Chinese capital flow in US dollars here. So what we've seen is the monthly flow has been strong, yet when we get to 2015, that changes, and it changes for the good. You can see our overall average trend line, the 12-month sum return, it effectively tanks. Okay, so we've seen capital flow in US dollars in the billions be very strong through 2013, through 2014, rejected, pulled out, billions and billions of dollars pulled out of the Chinese economy when there was a lot of fear and uncertainty. Again, I believe a spate of weak Chinese data, economic data, seemed to spark a sell-off in one particular day. It was Black Monday, and then the markets continued to move very rapidly as well. So effectively, that's what we've seen. We've seen a huge pullback in the equities. You've seen a huge contraction of US dollar investments in China, and effectively it has huge ramifications, very vast ramifications, not only for the currencies, but the equity markets and all other correlated asset classes determined obviously in China there and in Chinese yuan. Again, to discuss capital flight then for the currency, it's going to factor into our trading decisions as forex traders. More specifically, if we know that there's going to be a large increase over time, and then we can develop a directional bias if it's going to be a trade surplus perhaps for that country starting to develop over the next 5 years. We can factor that into our overall directional bias of a long-term trade. Okay, so capital flight often occurs in times of increased market uncertainty. This often translates to supported demand for safe haven assets and currencies. So a safe haven asset, again, I can use one example. The gold market is of course a safe haven asset. Why is that? Because it is a precious metal, and of course in times of uncertainty we can price gold with a certain level of value that a capital flight moves towards the gold market when as a barometer of risk as well, when we see that fear and uncertainty enter the markets. In terms of currency pairs, notable safe haven currencies are the US dollar and the Japanese yen, although nowadays it is more often the Japanese yen that is used as a currency barometer of risk. Okay, and the reason for the US, just more recently in relative times is of course it is continuing to run such a vast trade deficit that it is no longer able to support that capital flight just on the currency expectations. So we use, a lot of us traders, when we see fear and uncertainty enter the markets, you get to see how real that is, how real it is. If there's increasing demand for Japanese yen, you're going to see that forex currency pair rise across its other majors and minors. Okay, market sentiment then often lends itself to attack domestic currency. Short selling of the currency is what we mean by that, so attacking the currency if speculators believe the economy to be weak or undergoing difficult change. So if we believe that one specific economy is going to be weak for a very strong time, what is that going to do for the relative currency? Again, I can use this as an example more close to home in the Eurozone. It took the Eurozone quite a long time to recover from the financial crisis there, 2008, 2009. And what we've seen was the euro trade down quite strongly from around 140. Obviously, before that, it was a lot stronger at 2 euros to the dollar almost. However, you've seen a trade down over a long period of 6-7 years, right down to almost 112s, and then over the last year and a half, we've seen a nice strong bounce because economic growth is starting to really come into play in the Eurozone. You're seeing that statement, that mission statement from Eurozone President, ECB President Mario Draghi, consistently suggesting we're seeing subdued level of growth. However, it's growth, and The only real concern is for us is our battle with inflation. We are seeing continued but subdued growth. So again, that full economic story in terms of confidence, in terms of growth in the Eurozone, is leading to support the euro over the dollar from a bounce there of around the 112 to 130 there, or one just touching 120, 126 there, not so long ago. So again, very supportive of the currency. Again, with trade flows and commodity markets, we can analyze all of these specific moves across asset classes. When we analyze trade flows, capital flows, and understand, well, of course, they have a very important role to play in pricing all asset classes. What is likely to happen? The balance of trade for these countries that rely heavily on stable oil prices if oil prices experience a sharp decline. Okay, what is likely to happen? So here what we have in front is, let's actually observe the middle charting first. What we have is a collection of countries that, as a percentage, the countries are most dependent on oil to fuel economic growth. Okay, so this is as a percentage of their GDP, their reliance on oil. So you see Kuwait there at the top, well, 55% there in terms of GDP for its oil pricing. That's huge. And again, what I'd like to do is just to go along our ladder, we can see Iraq, Angola, Oman, some huge producers, so heavily dependent on the oil price for their GDP, for their level of output. So what I've done here is just stopped at Iran because it's quite interesting in terms of global discussion that we have at the moment. And I can just draw a line right down to Iran that we have at the moment. So we have roughly around 25% Iran is reliant towards the level of production and the level of value creation it does in the export market for its gross domestic product, for its GDP. Okay, and then on the left here, so we have a hypothetical chart. We have the oil price moving to the upside. We have Libya as well. Again, we can assume these are minimum operating profits for Middle Eastern oil. Okay, so for these countries to operate profitably at a minimum, Libya needs perhaps the oil market to be at 50 per barrel. Iraq needs the oil market perhaps 55 per barrel, and Iran perhaps around $60 per barrel. We need this price here just to sustain, okay, as a minimum for operating costs for the economy or for the export function of that market. So again, in answering the question, well, of course, it's very, very important. What is likely to happen if oil prices start to decline? Well, these economies are certainly going to be in trouble, in very, very serious trouble. How would a large decline in demand for oil affect the local export market? Okay, so if the large decline in oil is very real and affecting so greatly a lot of these countries that are producing oil, if they're effectively able to make profit on that level, well, then they'll still try and make the profit, but it's going to have a huge effect in terms of the trade surplus or deficit that they are running. So let's take Iran for example. Its level of value created by imports is $55 billion. Its level of value created by exports is $60 billion. Okay, so that's great. It's actually running then at a surplus of $5 billion. However, if oil prices decrease by 50%, say for example, well, you're going to see something quite significant change in the function of their trade balance of payments. So can you see how important that is in factoring in these certain moves on economies? And again, these are things that happen all the time. We see the oil price decline there quite severely over 2015-16, again, on from a move from 2014. We've seen many times over the last 50 years oil prices rally and decline, and many shocks have been experienced. But the point as well is trade flows can affect commodity markets. They can affect those national equity markets. Everything is interlinked with capital flow as well as we move across trading these assets. So again, we can go into more detail just with hypothetical, of course, economic sanctioning. and really discuss the effect of economic sanctions on trade and capital flow. And I'll give you three real world examples, more relative in terms of the past 3 to 4 years. Iran is now facing economic sanctions from the United States after the US pulled out of the Iran nuclear deal. Again, that's just there Tuesday this week. Sanctions will mean Iran will not be able to sell its oil to US clients, and as such, we'll see a drastic decrease in the export market share. That is the cause and effect of such a consequence. This is sure to add to pressure to the Iranian trade deficit. Okay. Let's choose another example. Well, China has faced certain US import taxes again relatively recently on metal commodities such as iron and aluminium. So what is this? What sort of effect is this going to have on the Chinese market? Well, China is a large producer of these metal products and is now at a real disadvantage in the metal export markets. Again, this is going to have a factor on its trade surplus or deficit. And again, Russian enterprise entirely and individual assets in the US totals a value of $160 billion. And they are now at risk in Western banks because we have continuing economic sanctions with Russia as a position there. Drastic changes in policy will indefinitely upset the capital flows in Russia. And again, this is one of the huge factors. I was trading there quite heavily, the European equity markets when Russia went into Crimea a few years ago, not only because of the political turmoil that ensued or the level of potential conflict there, did the equity market sell off, but that's what market participants do. They price in the level of capital flow that might be jeopardized, and trade relations that might be jeopardized as such, and what that means for such large companies, perhaps Gazprom, a huge oil and natural gas producer there, Gazprom in Russia, and obviously it does a lot of business there in European export markets. So it's all factoring in to the same sort of equation. All of these markets are completely inextricably linked in terms of global connectivity. We all do business with one another now, and this is how we start to price in fundamental trade decisions in terms of capital flow and trade flow throughout the nation. So to bring you on to our lesson summary, a very, very enjoyable, very complex lesson, of course. We have both flows of trade and capital are increasingly important to economies as globalization of industry and business creation continues. Okay. Trade and capital flows are inextricably linked to global health and output. And with better understanding the flow of investment capital, we allow us to adapt to follow the money trades or follow the money situations in identifying capital flight opportunities. So again, we know everything's linked together. We now know the importance of trade flow and capital flow in terms of capital investment. We know that trade flows and capital are increasingly important to economies as globalization and interconnectivity includes. When you do have a new small business enterprise opening and it's doing most of its business online, there's a certain complex nature to that new business that deserves appreciation for the export market, which wasn't the case previously. And of course, we can adapt to certain situations as they evolve with new news flow to developing how we trade. And again, it's something that's going to factor into your trading more than you really realize. I know the deliberations of the Brexit situation have been ongoing. Let's say we get some concord over this, in the next 6 months with Theresa May's government and the Eurozone Barnier. We're of course going to reconcile that, and we're going to price in what this means for trade flow and trade capital and a regrowth of cross-border business. So that is how we look to price in these assets and really divide its importance across different markets. So congratulations then, we have now finished this webinar, of course, the Become a Pro webinar, lesson 7. So we're getting through them, a lot to take in, of course, and I do, of course, would like to advise you to consult this lesson and revise it. It's a lot to take in at this stage, of course, given the complex nature of our Become a Pro course. You have all access to this, of course, in your members login area there at forex.academy. What I'll do is let you go for the rest of the evening. I hope you enjoyed today's lesson. You can, of course, revise it in the members login area as suggested, so do that. Of course, there's a lot to take in fully understanding the complex nature of trade and capital flows. What I'd like to do now is thank you very much for joining us here at Forex Academy. We'll see you next time. Bye for now.